An upcoming investor superstar, arguably the next Warren Buffett, an investor that is fairly well known in the value investing community, but lesser known among the general investing public. He just made a new investment last quarter, and I would argue that he has chosen to put his money, around $60 million in total, into a company that arguably pursues the best business model in the world, and that another superstar investor, Bill Ackman, also owns. So in this video, we will reveal who this underrated and upcoming investor superstar is, what company he chose to invest in, and why the business model of this company is so powerful. So without further ado, let's get started. Alright, hey there, my name is René Zellman, and to get straight to the point of this video, the investing guru that I want to talk about in today's video, that's Dennis Hong. Dennis Hong is founder and CEO of the Boston-based investment firm ShawSpring Partners, which he launched in 2014 with approximately $10 million in assets under management and turned into a much larger hedge fund. As of 2022, Dennis Hong probably managed close to, or maybe even more than $1 billion in assets under management. We cannot know for sure how much money exactly he is managing, but his US holdings alone represent around $560 million. And I think he has some significant foreign holdings as well. Now, what's remarkable is that Dennis Hong made a new and significant investment in Q2 of 2022 as his 13F revealed a new 10% position. This is definitely newsworthy, as Dennis Hong tends to be quite patient and selective when it comes to adding new stocks to his portfolio. In the entire year of 2021, for example, Hong only added one stock to his portfolio. So you could argue that he seems to follow the Warren Buffett 20-hole punch card approach. Although, to be fair, we don't really know how active he's been in international stock markets. Anyway, before I reveal the stock that he invested in, I wanted to discuss the business model of this company, because this business model is so powerful that I think it is worth understanding the dynamics and entry barriers of this business model first. So let's talk about the franchising business model. According to Investopedia, a franchise is a business whereby the owner licenses its operations along with its products, branding, and knowledge in exchange for a franchise fee. So by paying the franchisor a fee, the franchisee is granted the right and obligation to establish a franchise location using the franchisor's business systems, name, know-how, logo, supplies, and so on and so forth. For example, Starbucks is a common example of a well thought out franchising concept. And other well-known businesses that operate a franchise model are Domino's Pizza, McDonald's, KFC, and Burger King, which all operate food businesses, as well as Hilton Worldwide Holdings and Marriott International, so hospitality companies. And the economics of this business model are incredibly attractive. That's because it is an incredibly asset-light business model, meaning a company has relatively little ownership of assets, so only a small amount of fixed assets on the balance sheet, such as PP&E, so property, plant, and equipment. And these businesses require relatively small amounts of investments to produce new goods or services. Essentially, the franchising business model allows franchisors quick business growth that is primarily funded by the franchisees. Let me say this again. Most of the growth is funded by the franchisees and not the company itself. So all of the investment risk naturally is with the franchisee. And of course, this business model is super lucrative. But even though this business model is so attractive, it's hard to establish a company that pursues this business model. Because one main requirement to start a franchising business is to have a very strong and trusted brand, and a business that is strong and profitable enough for a third party, the franchisee, to enjoy attractive returns as well. The authors of the book Quality Investing write, such characteristics are developed over time. Most predominantly franchised businesses have gradually migrated from making money and building brand equity in company-owned outlets. It's difficult to franchise out a new, unestablished brand. And on another page they write, franchising is arguably the ultimate expression of brand power. And this brings us to Dennis Hong's newest addition to his portfolio. It's a company with a very strong brand and a long history. It It was founded more than 100 years ago, in 1919. And that's Hilton Worldwide, ticker HLT. Most of you are probably aware of the Hilton brand, so the brand itself needs no introduction. But many of you probably didn't know that Hilton generates most of its profits through the franchising segment and with franchising fees. Obviously, building and operating hotels is a rather capital-intensive business that requires significant upfront investments and a high level of fixed costs. According to the Hilton 2020 franchise disclosure document, costs associated with setting up a new Hilton hotel with around 300 rooms range from 30 million to 130 million US dollars. And these upfront costs and investments, of course, come with high risks as well. So that's certainly not the most attractive business model that you can think of. But as you already know, Hilton owns virtually none of the Hilton properties. They own only 54 of the 7,000 properties that are run under one of their brands. And instead, most of the business is operated via the management and franchising segment, which also generates most of the revenue and profits. Hotel owners who want to use any of the brands that are owned by Hilton pay Hilton a percentage of gross revenue or operating profit. And in return, they receive several benefits, such as gaining access to 139 million loyalty members, Hilton's marketing campaigns, training programs, and the IT system, and of course their reservation system. To give you some numbers here, to open a Hilton hotel franchise, a franchisee should expect to pay an initial franchise fee of 75,000 US dollars, a monthly royalty fee of 5% of gross rooms revenue, and a 4% advertising fee. And then there are a host of other fees. To quote from their most recent 10K, we manage hotels and license our brands through our management and franchise segment, which included 745 managed hotels and 5,978 franchised hotels. This segment generates its revenue primarily from fees charged to hotel owners under management and franchise contracts, as well as from fees associated with license agreement. We grow our management and franchise business by attracting owners to become part of our system and participate in our commercial services to support their properties. These contracts require little or no capital investment to initiate on our part and provide significant return on investment for us as fees are earned and paid. So the franchising model and not owning physical properties itself helps Hilton to grow faster, especially internationally and in smaller markets where local developers might want to start a hotel that Hilton otherwise might not consider. I think what's also great about their business model is that the franchise contracts typically have initial terms of approximately 20 years for new hotels and approximately 10 to 20 years for hotels that are converting from a brand outside of the Hilton system to a Hilton-owned brand. So the length of these contracts gives the business and investors a great deal of visibility as well. Now, as of today, the company trades at a free cash flow multiple of 30 and an enterprise value to operating income multiple of 26, which, to be fair, is not particularly cheap for a company that saw fairly modest revenue growth over the last 10 years. Hilton is also trading at a higher multiple than some of its competitors like Hyatt and Marriott, which run similar business models. However, arguably such a multiple, so in the high 20s or even the 30s, could also be considered reasonable for a capital-light compounder with a durable business model like Hilton. If you've watched my last video, which I highly recommend by the way, you will understand that whether a company with a valuation multiple in the mid-20s, with a valuation multiple this high, can be considered cheap depends largely on the future growth prospects. For specifically, the growth potential, I think, will be primarily influenced by three factors: new unit growth, revenue per available room, and to a lesser extent, franchise fee increases. Now, I'm not going to do a 40 to 50 minute deep dive on Hilton in this video, but I want to recommend a couple of sources that you should take a look at if you want to understand each of these growth drivers a little better and to be able to come up with a reasonable growth estimate for the next 5 to 10 years yourself. First of all, there's an excellent write-up on the website of Eagle Point Capital from 2020. And second of all, I recommend going through the public filings of Hilton, the investor presentations, conference calls, and financial statements. Personally, I think the stock is really not a bargain at its current price. I think it's a fabulous business model, and we're looking at a super durable business that is generating free cash flow margins north of 30%, and that very likely is still going to be around 20 years from now. However, I don't see the company growing at a rate that justifies the current valuation. Or at least I don't think it's a no-brainer investment at the current price. So if you want to understand how I come up with my fair value estimates, you should watch the following video next. Take care.